Okay, good afternoon, everybody, and warm welcome to this webinar, which has been organized by SOLA Group. And we've got some very interesting speakers and topics to talk through today. The main title of the day is going to be power purchase agreements for industrial businesses. And my name is Chris Hall. I'm the chairman and the head of project finance at SOLA Group. And we have my job is to introduce a couple of the other speakers today, and also then to give you an overview of power purchase agreements and as we see them applying to solar energy in Africa and South Africa today. And we've had a lot of interest in this webinar. I think there's been more than 250 people that have or more than 220 people that have shown interest. So we're very excited to be talking to you, and hopefully there'll be an opportunity also to engage through the various question channels that have been set up through this webinar. I must admit, this is the first time that I've done one of these, so apologies if there are a few little technical glitches from my side, but I'll try and be as professional as possible in delivering the webinar to you. So apart from myself, we've got 3 other speakers, and each of us are going to talk for about 15 minutes. So after my introduction, I'm going to hand over to Gugulethu Nogaya, who is the head of energy and fluids at AB InBev, and he's going to be talking about how PPAs enable clean energy procurement at AB InBev. AB InBev and SOLA have been working together on some power purchase agreements, so we have some practical experience to talk through there. We also then have joining us after Gugulethu, Zach Ferreira from Nedbank, and he'll be talking about funding renewable energy projects from a lender's perspective, representing Nedbank. And after Zach will be Mitesh Pema, who will be talking about the potential of PPAs to provide clean energy in Africa, and speaking from the perspective of an equity funder representing Africa Infrastructure Investment Managers, or AM. So we've got some exciting speakers there. I'm looking forward to hearing some of the information that's being delivered, and to also get some of your interactions and discussions. So to start off with, just a quick introduction to SOLA Group. We've been in operation for almost 10 years now, and started out initially with our roots in the development of large-scale projects for the IPP program in South Africa. And since starting out at that time, we've successfully developed over 310 megawatts of power purchase agreement projects. And we've also branched out into spending more time recently, as that independent power producer program has experienced delays, into engaging with private businesses on the commercial and industrial side, where we've now constructed and built and operate just over 37 megawatts of projects, including some battery storage projects, which we have under operation, just under 2 megawatt hours. And through that process, I think we've picked up a fair bit about how to deal with customers, clients, utilities, governments in the context of power purchase agreements, and specifically to the technology in question here today, which is solar. So I'm going to try in sort of the short space of time answer a couple of questions. But before I do that, I want to give a quick general overview of solar as we see it at the moment in terms of the conditions. I'll then speak to what is a PPA. I'll go into what are the different solar PPA tariff levels that we currently see in South Africa in terms of the costs. What factors affect the price that can be offered in a PPA? What are the risks and the concerns that a buyer might have and that a seller might have in developing a PPA project? And what questions should a prospective buyer ask when he's evaluating a prospective seller? how can the term of a PPA be reduced? And then lastly, what sort of clients benefit most from a power purchase agreement? So I just briefly want to talk through these two slides, which were taken from the International Energy Agency World Energy Outlook. It's a little bit out of date, 2017, but it just shows the global expectation for solar over the next sort of medium to long term period up to 2040. And as you can see in that graph, which is showing the average annual capacity additions and retirements by technology in the across different technologies. And what you can see there is that solar PV is expected to be the most adopted technology in terms of annual gigawatts that are installed, with just under 90 gigawatts being installed on average every year between now and 2040, which indicates that the expectation is a total addressable market globally of more than 2,000 gigawatts. And in Africa, which is a small slice out of the different colors represent the different regions and so on. We're looking at more than 100 gigawatts of power. So all expectations are that solar PV is going to be the dominant form of energy generation going forward. And the reason for that is because when you have a look at the cost of solar energy that's being produced by, admittedly, this is utility scale assets in Africa. Already in most African countries, that level is below what both the wholesale price currently or in 2016 was, and what it's expected to be in 2040, which is the little blue dot. And that price differential is really what has been driving solar PV's continued growth, and also the expectation from these large international consulting companies as to the reason why it's expected to be the fastest growing technology going forward. And obviously a power purchase agreement is one particular way of actually procuring this type of technology if you're a consumer. And how a power purchase agreement is defined is that it is typically a long-term agreement to take or pay for all of the power that's produced from a generator. It usually has a fixed price and a fixed escalator, and it's typically quite long. It's quite long because solar PV has very low operating costs, but it has very high capex costs. And so in order to achieve a very low power cost, the recoupment of that investment needs to take place over a period of time. And so the length of the agreement sometimes is an issue, but typically what we're seeing at the moment is that those power purchase agreements are ranging between 10 and, in some cases, 25 years. And the advantage of having a longer agreement is that one can obviously have a lower starting tariff. A shorter agreement gives the client more flexibility. And the agreement, as well as the credit risk of the off-taker, then allows the financier to invest in constructing a project which is specifically for that off-taker, for a return appropriate to the risk taken, and thereby allowing the off-taker or the consumer to start procuring solar power without actually putting up any capital cost at all. And if that solar power is cheaper than your prevailing source of energy, one can experience an immediate saving from day one without actually outlaying any capital cost. So I just want to show this graph here, which illustrates the benefits of a PPA to an example customer. And what the graph shows is this blue line at the very top is the utility bill without solar. So that's what you would be ordinarily paying to the utility. The yellow strip is the solar bill that would be paid according to the power purchase agreement. The little green blocks at the bottom are the net annual savings that are produced from purchasing the solar power as opposed to having to buy that power from the utility bill. And so the new bill is essentially the utility bill with the solar plus the little yellow strip, and that's how the savings are generated through a power purchase agreement. So Obviously, compared to if you were to buy a solar system yourself out front, where you would be able to experience 100% of the savings, a PPA allows you to experience less of the savings, but then obviously without having to outlay the capital cost and have the associated cost with that capital being deployed and locked up in a solar system being incurred by the consumer. So I'm just going to try and quickly see if I can get my, there we go. So where are the PPA levels for solar PV currently in South Africa? We believe that they at the moment are sitting around a range of between around 90 to 110 cents per kilowatt hour. And the factors that affect that price are twofold, really. They're technical and financial. In terms of the technical factors, the size of the project, the complexity of the project, and that includes the angles that the roofs may be at, the number of roofs that one has to consider, and the connection into the actual existing infrastructure, which can be quite complicated at times. The solar radiation, of course, and then the prevailing module price and the load consumption of the buyer, so that the energy that's being produced is actually properly consumed by the buyer. And in some cases, you'd have to have a wastage on the model, which would essentially have to result in an increased tariff if you're not consuming all of that power. And then on the financial side, the creditworthiness of the buyer, which particularly includes, creditworthiness is sometimes a little bit of a vague term, but the financial wherewithal of that client in respect of the size of the project is a critical factor as to that affects the cost of the financing. And so one would want to see the annual financial statements for the last 3 years, and also understand that business that you're contracting with has a reasonably secure future in terms of cash flows and the ability to service that power purchase agreement. And that's that also leads into the concept of bankability. So a financier would want to know that offtake risk has been sufficiently catered for in the return profile, as well as the other risks in the project being covered either by your EPC and O&M contract, or if the risk is not there, either by the off-taker or then alternatively by an insurance contract, which would cover a risk that falls in between those agreements. The finance costs and the transactional costs affect the PPA price, because you'll have essentially a fixed cost to finance and put together a project. And as the project scales, that cost becomes relatively a larger or smaller proportion of the project size. And so it's much more affordable to be doing a portfolio of projects or a sizable project on a PPA basis, because one is able to absorb those transactional costs easier and not have them affect the tariff as radically. And then lastly, obviously the list that I've given here is not exhaustive, but just for speed of moving on, I'd like to talk about the foreign exchange rates and the interest rates, which are also a factor that affects the cost of the PPA at the end of the day. And also variation in those rates make it quite difficult for a customer, the expectation of a customer to be managed through the initial engagement right to the point where the contracts are finally secured. Because as those rates fluctuate, it affects the tariff at the end of the day, and then the client may on the updated tariff find that the project is not feasible anymore after a lot of development work. The risks and concerns around developing a PPA project, I think from a client's perspective, it's at the moment it's very difficult for a client to determine the correct balance between the credibility of a potential seller, of a developer, and the price that's being offered, because it's very easy to put a price forward in terms of a PPA project. It's just a single number per kilowatt hour, and often what happens is that because there's not a established market and a significant track record with a lot of these companies, is that it becomes difficult for the clients to actually ascertain whether or not that is a valid bid by a party that's able to deliver that project, or whether that party is in fact just buying themselves an option to try and work the project out at a later stage, and then bring other entities in to try and make the project viable, and hope that the project is viable at that tariff. And so I think the underestimation of that project development time and the effort required to actually bring a project into operation is something that really needs to be thought about carefully by the potential customer, because otherwise one can spend a lot of time, waste a lot of time also by choosing what one thinks is a very attractive tariff, and then working out actually that the bidder never had the wherewithal or had the right modeling in place to actually work out that tariff was a viable tariff to build a project on. So the kind of questions that a prospective buyer should be asking a prospective seller is, which entity is building the plant and guaranteeing the output of the performance? Is it the balance sheet of that particular entity that's building the project actually larger than at least larger than the project itself, but preferably 2 or 3 times larger than the value of the project itself? Who is actually committing capital to the project? And if it's a third party, has that third party actually given unconditional commitment to providing the capital to the project, or is it a very non-binding letter that actually is fairly weak? What is the track record of that entity with similar projects and similar buyers? If the proposed tariff that one sees in let's say it's in a bid scenario where you might ask for 5 or 6 different tariffs, and if one of the tariffs is 20 or 30% lower than where the average is sitting, then the customer needs to ask themselves, what is the reason that tariff is sitting so much lower, and actually really try and dig into what the difference is, rather than assuming, okay, great, I've got a really good price, let me just work ahead with the project, only to actually never actually get a project at the end of the day. Rather try and understand why has that difference happened, and actually be alerted that if there is such a big difference in tariff, that is actually that's a warning sign that you may be dealing with a bidder that's actually lowballed the tariff and looking for an option on a project, rather than a bidder that actually has done its homework to work out that you've got a real viable project. So one of the questions we often get asked is, how can we reduce the term of the power purchase agreement? The agreement is a long-term agreement, and generally businesses and anybody would prefer not to sign long-term agreements because it allows for more flexibility. So there is a tendency to want to try and reduce the term of the PPA. It is possible to have lower term PPAs, but obviously the economics of the PPA still need to make sense for the financier and for the person who's putting up the tens or potentially hundreds of millions of rands that go into such a project. So one can either agree on a higher starting tariff, which can then allow for the return to be recouped over the shorter time period, or one can agree to a buyout or a termination payment after the shorter PPA term, or potentially a relocation mechanism where the customer says, okay, I actually want to move this solar project, but I'm willing to pay the costs to have moved from this particular location, which doesn't work for me anymore, to another location, and the project then gets moved and the PPA extended. And the other assumption is to assume that the project has the ability to actually sell its power to another client should that client not be the off-taker any longer. And in South Africa, this is quite a difficult concept because the way our electricity market is structured at the moment is that it's quite closed, and so it makes it quite difficult for a project to easily engage in the market and find other off-takers. And for that reason, financiers and project developers and owners would be reluctant to actually place any value on a period of time after the contracted part of a power purchase agreement, unless there are very clear mechanisms in place in terms of your grid connection, your access to the grid, and the various agreements that would be required from the grid operator to allow for that particular mechanism to be viable. And then lastly, what sort of clients benefit most from PPA? So to be quite honest, any client can benefit from a PPA. Anyone seeking to drop their operational costs can benefit from a power purchase agreement. And in the current climate in South Africa, particularly, we think this is especially relevant. The economic times at the moment are difficult. They're hard, and companies are looking for ways to try and improve their margins and to improve their financial results. A power purchase agreement offers a very nice, simple mechanism to in a short space of time, improve your operational costs and also reduce your carbon footprint by engaging in a power purchase agreement, which allows a third-party company to take most of the risk and to provide most of the financing, and to give you the benefit on an immediate time frame. So businesses that are sensitive to operational cost improvements, and we find manufacturing entities and industrial type of complex companies being particularly prone to those sort of sensitivities. We find that the power purchase agreement really suits those sort of customers. And in South Africa, as you might know, 70% of all the energy is consumed by such customers. So we do think that there's a good opportunity for customers like that in using a power purchase agreement. So I've gone a little bit over my time, but I would like to now introduce, assuming that his connection is working, Gugulethu Nogaya from AB InBev, and he's going to talk a little bit about clean energy procurement in PPAs. Okay, sorry, I've just been informed that actually we're going to swap the order slightly because Gugulethu is battling to get in. So next we're going to go to Zach Ferreira from Nedbank.
My name is Zach Ferreira. I'm from Nedbank. I'm an associate in the energy finance team. The first question that was posed to me is that how do we envision the embedded space growing? And I'll just have to give a bit of background on where Nedbank started this journey. On the back of very successful refinancing before the slump up to round 3, Nedbank decided approximately 2 years ago that the C&I embedded PV space will become a future trend, and we worked quite closely with sponsors and developers in industry to develop a financing structure that fits into the private PPA model. It's taken some time. I think our journey with SOLA Group has been for approximately a year now. But as you've seen in their latest publications, that we have finally made available a facility for them to roll out corporate PPAs to the likes of AB InBev, which Gugulethu will talk to a bit later. Other drivers from our point of view in industry that will be pushing the market towards private PPAs are, of course, the increase in electricity tariffs from the grid, municipal and Eskom. And we've seen corporate and industrial energy users driving through offsetting their grid power to get to energy savings. Then the latest estimates that we saw is that it's estimated that about the amount of PV being installed in 2019 will be approximately double what was installed the previous year in 2018. That's specifically in the industrial rooftop space. Other big drivers for the embedded space we've seen is the sustainability goals that are being set by corporates, such as the likes of Unilever, AB InBev, and other multinational companies spread across the continent. Another driver is also that there's expected to be a lot of grid instability through load shedding, and what industrial users do is they combine their generators with PV to finally offset the cost of fuel to generate power. And then lastly, a point that was made actually in Tito Mbueni's announcements on Tuesday for our economic development plan is in the pipeline there's the potential for deregulation of the electricity grid when Eskom is restructured into transmission, distribution and generation. What's meant by that is deregulating the grid so that potential private owners of solar systems could feed back into the grid for compensation from a municipal energy buyer. The other two aspects included are energy banking, where a PV plant can feed energy back into the grid and basically bank the kilowatt hours, even if they're not using it at that time, and use it at a later stage. And then, of course, I saw a question just posted about wheeling. That also offers great potential for companies that basically virtually wants to offset their carbon footprint. Yeah, and then answering the second question on why it is better to go with this type of PPA that SOLA offers. I'll have to give some background on how we got to this stage of being able to give them the debt financing that they required. This financing is structured around project finance principles, which means that there is quite a stringent process that SOLA had to go through to be able to qualify for the debt finance. That includes a number of things: doing a technical due diligence on SOLA's capability to execute the installation of PV projects. Nedbank employed an external technical advisor to conduct the engineering review of all their work, as well as their plant performance. What we furthered then is we had to go through a big legal process where we've created a structure where the solar assets that SOLA are deploying are formed in a security, in a special purpose vehicle that enables Nedbank to offer non-recourse senior debt financing to SOLA. Yeah, the other reason why it is better for corporates to go on this form of PPA is that companies can then focus on their core business. For example, AB InBev is in the business of making beer and not specifically generating electricity. So what that means is that they've structured the agreements that it's on take or pay agreements, for example, which would mean that if SOLA is not delivering the kilowatt hours promised, AB InBev will not be held liable to pay for what has not been delivered. Yes, and that's basically the short and sweet from Nedbank's side. I see there are many questions being posted. When we get a chance, I'll answer them. I see here's a question on how does Nedbank manage foreign currency and exchange risks in the PPAs. Generally, the PPAs that we provide debt financing for in South Africa is rand-based, and the debt is also rand-based. So that is how these foreign currency exchange risks are mitigated. Yeah, I think I see Mitesh has been put on stage at the bottom.
Great. Thank you so much, Zach. Thanks for that. That's appreciated. And again, apologies about the technical glitches. We're going to put Mitesh on next. Thanks, Mitesh. We can see you. And we're going to still try and get hold of Gugulethu, and hopefully he will speak after Mitesh. So thanks so much, Zach, and Mitesh, take it away.
Thank you very much.
Well, thanks, Zach. Thanks, Kate, and good afternoon, everyone. Thank you for joining us. I think we've heard from both Chris and Zach, in quite a bit of detail, some of the more technical aspects of PPAs and how they work and could work. So I will focus more on our considerations as an investor into these types of projects and how our investment is aimed at benefiting the end users in these types of projects. So just as a brief background, African infrastructure investment managers has a mandate to invest in infrastructure assets across the energy, transport, water, and telecom spaces. These are types of assets that provide a foundation for economic activity in a country or region, and hence the cash flows tend to reflect a much lower volatility through the ups and downs of an economic cycle than a commercial or industrial business would. In the energy space, we have investments in almost 2.5 gigawatts of utility scale electricity generating plants. But we've also realized over time that there's still a huge need for electricity on the continent, and with over 500 million people still without access to electricity, we need to find new and innovative solutions in connecting people and allowing them access to electricity. And so, we in the recent past have been pursuing a number of investment opportunities in the off-grid, embedded generation, or microgrid spaces. And we've got significant investments in, things like solar home systems in the East African region. We have a similar investment in, embedded generation developer in West Africa. And our partnership with the SOLA group is a continuation of our intent to expand the space and bring more people, or connect more people to the grid, or allow them access to electricity generally. So the investors, an important part of understanding our role as investors in these types of projects is to understand, I guess, what we do. And the investors we represent are typically pension funds and insurance companies, or long-term insurers who have long-dated liabilities. With these types of projects and solar PV technology in particular, we can predict with a relatively high level of confidence the electricity that a photovoltaic installation will be able to generate. So then when we overlay that with the certainty of revenue that a power purchase agreement provides, this adds to our confidence in the medium to long-term cash flow forecasts. And when we do this, that enhances our ability to match investors with the appetite for the long-term cash yielding nature of these projects. And the appropriate matching of the project dynamics and the return dynamics offered by these projects with investors with the appetite for those dynamics ensures that we are able to lower the cost of capital and the cost of financing to an optimal level. So it's by matching, investors with an appetite for the types of returns that these projects generate, which is generally long-term cash yielding as opposed to high capital growth returns, that we bring down the overall cost of capital. And this then is reflected or filters down into the tariff we're able to offer to the off-taker ultimately. And so, what we are able to offer when we optimize the financing mix is a very competitive tariff in relation to the tariffs charged by large utilities, which generally dominate the landscape in Africa. And so it's competitive tariffs, and for the portion of the electricity that we provide to a user, the user is provided with certainty of cost escalations over the PPA term. So those are our considerations as an equity investor. So the growth in the in this space of CNI backed PPAs is attractive to us because we manage, or particularly attractive to us as AIM, I should say, is because we manage pools of capital that are well suited to the returns delivered by these types of projects and are very competitive in this space. Obviously, that then allows us to fulfill our mandate of increasing infrastructure on the continent, improving infrastructure on the continent, and making access available to more users who are currently not connected or have limited access to power. The last thing I wanted to mention is, we've talked about PPAs and the technical aspects of that, but the other thing we see our role as is, as we create more projects of these natures, is the ability to consolidate them into larger portfolios, and that's attractive to us for two reasons. The first is, we think that from both an operational and a financing perspective, the allocation of risks, and particularly here I'm talking about the risks associated with generating electricity, are better placed with parties that are able to manage them. So, parties like the SOLA group, who, this is their business day to day, building photovoltaic plants, operating them over the long term. There are a lot of synergies across the projects that they do, that they're able to bring to bear. And so, their ability and the cost of them managing the risks associated with an operating photovoltaic plant are much more efficient than if a commercial or industrial business was to try and undertake that themselves. So, we've seen an evolution in the market, and we still see a number of businesses looking for a build-only solution, i.e., they're willing to outlay the upfront capital cost to build a facility on a rooftop or at a site. But we think that, the long-term cost associated with building and operating that site is more expensive, where we see commercial and industrial businesses trying to do that themselves, and it's not their speciality, versus when an IPP, whose speciality it is to do to build and operate these plants, is involved. And then secondly, the growth opportunity for us. So firstly, it's an efficiency aspect. That's very attractive to us, and we're the party best able to manage the risks and operations of such an activity is doing that. Then that delivers an efficiency for us. And then secondly is the growth opportunity. So in building portfolios of similar types of projects, we may reach a stage, or we're hoping to reach a stage where we're able to then manage the load and the customer needs across a wider portfolio. And then as the regulatory environment loosens up and these types of facilities are able to feed into the grid, then there's an opportunity there to grow these businesses and to be part of the broader generation mix in the country, as opposed to supplying specific customers on the back of these PPAs. So there's a significant growth opportunity there, which is not captured because currently the regulation limits us from feeding into the grid. But it's I think this is a prime example of a case where regulations are catching up with market activity. So I think what we're seeing continually and increasingly is that customers are starting to understand the cost benefits provided by these projects. The fact that they can procure a portion of their power at cheaper than they would from an Eskom or similar utility, and they're making a plan and those customers and businesses like SOLA are finding ways to extract those cost savings, and in an environment where the regulation is not clear and doesn't explicitly provide a path to extracting those cost savings. And the regulation then is thus, what we're seeing is it's evolving, however slowly, but to catch up with, where the market is currently. So that's, from an investor's perspective, what attracts us to the space and how we, and the kind of, positives that have brought us to the space currently, but also the opportunities that we see in continuing to play a role and growing in the space into the future. Thank you.
Thanks so much, Mitesh. That's much appreciated. We've managed to get Gugulethu online, so I'm just going to put him on stage now. Thank you so much, Mitesh, and we'll address questions at the end.
Apologies, guys. I think we're having a bit of network issues, so please just bear with me. If the line drops, Kate will just call me directly, and I'll speak from my cell phone. Okay. Good afternoon. Anyway, my name is Gugulethu Nogaya, and I'm the Energy Fluids and Renewable Energy Procurement Manager at AB InBev Africa. And I guess the intent of this call from my perspective is just to almost give you a buyer's perspective and what we look for. And I'll touch on these questions, and I'll also just add a bit of perspective from my end. So what I'll do is just start with giving a bit of context as to where this started for AB InBev. So we started the journey, the renewable energy journey, in 2015, right? When the United Nations and world leaders agreed to 17 goals, which most people would know as the global goals, which would facilitate a better world by 2030. And the intent of the goals really was to look at ending poverty, it was to fight inequality, and it was to stop climate change. There are two specific goals within that we then latched onto to drive the renewable energy agenda. So it was goal 7, which speaks to renewable energy and providing clean, affordable access to energy across the African continent. And then it was also sustainable goal 13, which is climate action, and that speaks to reduction of carbon emissions, etc. So the journey started off in 2015 for ABI. Across the world, we've managed to move relatively fast. The USA is completely contracted. Australia was also completely contracted. We're moving well in China. And together with the merge that took place in 2016, where AB InBev actually acquired SAB, obviously by virtue of that, SAB then also had to look at reaching the 100% renewable energy integration by 2025, and that's the journey we on at the moment. And that's where the relationship with Solar Future started, because we partnered on our initial phase or rollout of on-site facilities in South Africa, and that's really where the relationship started. And I'll give context in line with what we've experienced together with Solar Future. The first point was, Kate asked me to speak on the main reasons for choosing a PPA to procure renewable energy. And I think the first and most obvious is capital relief, right? And that you don't have to put up capital yourself, you can focus on your core business and let this process run itself. The second benefit that we did see is that you receive immediate cash flow benefit, right? So from day one, when these projects go live, because of the differential to the grid price, you get your immediate benefit. And then something else that is important in business and for future planning is price certainty. So the benefit that comes with these PPAs is that you have price certainty and you know what your price would be for the next 20 years, which is something that we definitely do appreciate. And I think the most important to me and where I see the most value is on the execution of itself, of these projects themselves. These projects in their nature are extremely complex. And as a business, we brew beer. We don't have expertise in obviously running renewable energy projects. And it would take us a very long time to build that competence to get to a point whereby we could do it properly. So partnering with people that do this on a daily basis, as Mitesh had mentioned, definitely gives you the peace of mind. They taking this upon themselves and they commit to delivering the project with very little input from your end, as opposed to just making sure that your facilities are intact and can take the renewable energy facilities. And that definitely gives peace of mind with regards to the execution of these projects themselves. And I guess that's where we saw the most value. And then the next question that she had asked is, what do businesses stand to gain from going 100% renewable? The first benefit we definitely did see was that it's cost competitive with fossil fuels, and in most cases, it's actually better, priced a lot better than fossil fuels, especially in Africa, where we have a heavy reliance on either gas or oil slash diesel in most of the African countries that we operate within in West Africa and East Africa. So it definitely makes the world of difference within those areas. And then the second, obviously, is because we need to decarbonize to solve for climate change and global warming. With the power sector being the largest contributor of carbon emissions, it obviously just makes sense for us to go ahead on that basis. And I think something else that I wanted to touch on from a buyer's perspective, right, and the key challenges that we do have, um, and what and what and what technology providers and developers should be conscious of and should put forward as a value proposition to a buyer, is that I think the very first challenge that you will face when you're looking to procure renewable energy is that it's very difficult to find a reliable and capable partner that is also competitive, obviously. And I think if you can show that you are reliable and are capable of executing these, and what you will do to make sure that you are cost competitive, I think that would definitely help when presenting or putting a proposal together for a buyer. And secondly, you almost need, because all buyers aren't experts or don't understand the energy market as well as most people that are working in the space, you almost need to give the buyer insight on what is happening within the market. So give certainty on pricing, give an overview of the market and the dynamics within the market and what drives energy prices, so that you educate the buyer such that they can make a more informed decision with a bit of confidence. Because this is the area I find companies almost get paralyzed in, because they don't understand what this entails and what it means to be in a contract for 20 years. For instance, they fail at making a decision because they don't have this information. So if you could bring some insight and some information forward, that would definitely help and speed up the process, and is a great value proposition. And it's just a challenge, and I always put forward to people that bring forward solutions, is that I find that the industry, because obviously the guys that work within the industry understand it very well, almost think in a boxed manner, and their thinking to a degree is obviously constrained because they've been working within the space. So I just always challenge businesses to, or technology providers and developers, to think outside the box and work within their buyer's framework. Because if you can't do that, then the buyers obviously can't make a decision with regards to going ahead with the renewable energy PPAs. Yeah, no, and I think that's it from me. Yeah.
Great, thank you so much, Gugulethu. I appreciate that, and I'm glad we managed to get hold of you in the end. Chris is just going to wrap up with a couple of points at the end. So thanks all, and thanks for bearing with us through the technical challenges.
Yes, thanks, Kate, and also thanks to Gugulethu for those great words. I think we really admire AB InBev's commitment, and I think there's huge kudos to them to commit to those kind of aggressive targets of 100% renewables by 2025. It's fantastic that companies are doing that, and we obviously I think as a world, as a global community, need to encourage more and more companies to try and take up that challenge to help accelerate our world into a more sustainable, cleaner environment that gives our children a safer future. So really, it's a fantastic commitment, and I think it deserves a lot of respect. I just wanted to mention lastly that in terms of the parties that have been here, we have SOLA Group has established a partnership with African infrastructure investment managers and Nedbank through the Orionis Fund, and so we have raised a minimum amount of 400 million rand, which we are busy deploying into operational and under construction PPA projects. And we are open for business. We're looking for opportunities to do business with your companies and with your ideas. We think there is huge opportunity in this market to bring solutions like this to customers, and we want to make South Africa and Africa a better place by providing these solutions to you. Our philosophy is to think year 20. We're in it for the long term, and we are looking for partners that have a similar mindset to us, that look at things in a similar context to the way the speakers have presented things here today, in terms of quality, in terms of sustainability. And so on that note, I just want to thank everyone for joining, and I look forward to interacting with you as and when the time allows. I think I'm gonna hand over to Kate. I think we're almost out of time. So in terms of actually direct questions being answered verbally, I think there's not much time for that. We have been trying to answer the questions manually through the chat room. So if you do have questions there, please have a look there and see if they've been answered. And otherwise, I just want to thank our speakers again for their contribution. And thank you all for joining. Kate, over to you.
Thanks so much, Chris, and thanks again to all the speakers today. It was really, I think, a very productive discussion, and certainly a timeous one. From all of the sort of questions in the questions tab and the chats, there's a lot coming through there. So just to say that we will be ending the webinar shortly. There'll be a few more times for questions. We'll leave the room open until 1, but just if there are further questions, we are very happy to address those at any point. So our contact information is all on our website, sola.africa. You can also just email us, info@sola.africa, and we're very happy to answer all of those questions. And then after the webinar ends, you will get sent a link to a survey, and we'd really appreciate the feedback. These types of events are sort of new to us, and I think often in a South African context, new to South Africans in terms of a way of doing events. And so it's really important for us to get feedback, and just in terms of the quality and how the event was. So we would really appreciate that feedback. So from our side, thank you so much for joining today, and we really look forward to taking this conversation further. Thanks a lot.